Well, good evening, this is Hound Dog Steve coming to you on the 11th of January, and a very warm welcome to you all. You might see I've got an extra layer of clothing on this evening because it is a chilly -20 centigrade outside tonight, and that wind, oh my god, it will just cut you in two. Anyway, what I'd like to talk to you about this evening is a little article that I noticed on Zero Hedge, and it's entitled "Something Biblical is Coming." And I really like this article because it reaffirms some of the predictions that I made on New Year's Eve for the coming year 2019, and it gives three possible scenarios that we might go through in 2019-2020, and each one of them are cautionary tales. Each one of them are possible. I know which one I think is more likely of the three, and that is the one in my prediction. Anyway, let's go over and take a little look at that story, and we'll come back and we'll wrap up. Okay, here we go. Okay, Zero Hedge. Something biblical is approaching. Here are the scenarios of the collapse. Okay, so this was written by Tuomas Malanen of GNS Economics. 2019 has started more calmly after a very volatile year-end in the markets. Focus has been on the trade deal between China and the US, and the words of the central bankers, most notably those of Jay Powell. However, this is all just a distraction, a sideshow. The market volatility was only the first sign of an approaching global economic crisis, as we warned in December 2017. The global downturn has started, and the world is utterly unprepared for it. The global imbalances that have been growing for years cannot lead to anything else than a global crisis. However, there are different paths this crisis could take. Here we present three scenarios that the global economy is likely to follow when the global downturn morphs into something much more sinister. We'll start with the most likely scenario. Scenario 1, global depression. In a depression, everything that has driven the economic expansion goes into reverse. Asset markets experience severe contraction in excess of 50%, credit becomes restricted, corporations and households delever fiercely, and global trade flows stall. GDP falls dramatically between 10 to 25%, unemployment skyrockets, the standard means of stimulus by central banks and governments are exhausted without any notable improvements in the economic environment. The implosion of the current asset bubble will start a relentless unwinding of leverage and risk in the global financial system, because major central banks are still all in with rates pinned at or near historic lows and balance sheets bloated to extreme levels. Their ability to respond will be highly restricted. Governments are also highly indebted, and when interest rates rise, some sovereigns are likely to default, aggravating the global banking crisis, which will probably be in motion already. Combined with the zombified global business sector and hard landing in China, these factors will lead the world economy into a depression. However, a possibility of something even more ominous is lurking in the background. Scenario 2. Systematic meltdown. Systemic crisis would mean that the global financial melts down due to an existential deficit of trust between counterparties within the system. Before 2008, a systemic meltdown was mostly a theoretical construct. However, in mid-October 2008, global leaders were faced with the possibility that banks would not open on Monday. The interbank markets had frozen because no one knew the amount of the losses banks carried on their books. The global financial system was grinding to a halt. Politicians and central bankers saved the day by guaranteeing bank deposits and by providing capital and extraordinary guarantees to keep the important financial institutions standing and credit flowing. Now the problem is that many of these measures are already in play, and when the next crisis hits, the solvency of governments and central banks will also be in question. This creates a perilous situation because, for example, the shares of the global systemically important banks, GSIBs, have been falling since the beginning of last year, which was also the time when the balance sheet normalization program of the Feds kicked into full gear. This is no coincidence, and it implies that troubles are once again brewing in the banking sector. Because the crash in the asset values would affect the collateral of banks, and because global depression would lead to a massive increase in loan losses, the already impaired banking sector could again face collapse. However, this time around, there is very little authorities can do to stem the panic. These factors make the systemic meltdown an honestly likely scenario. Systemic meltdown would mean that all banking actions, distribution of money, loans, swaps, banking services, etc. through the banking sector would stop. Credit cards would cease to function, ATMs would not give out money, and loans could not be originated or rolled over. Following the likely collapse of global trade, the world economy would also collapse. This would imply that the global GDP would experience a harrowing fall of 20 to 40%. Modern societies would cease to exist in their current form. Scenario 3. The fairy tale. Could this all be averted somehow? We've been pondering this for 2 years now, and our resounding answer is no. The leverage in the system usually results in a crash at some point, and asset bubbles very rarely deflate in a controlled manner. However, central banks can probably still postpone the inevitable if they could restart the QE program, that's quantitative easing, or find some other way to push artificial central bank liquidity into the financial markets. To soften the eventual blow, and as an extremely desperate measure, central banks could, at least in theory, engage in a quantitative easing squared. In it, major central banks would buy a hefty chunk of the global risk assets, estimated to total 400 trillion. This would mean that the balance sheets of major central banks would need to expand at least fivefold from the current level of approximately 20 trillion. To cover the crippling losses to their collective balance sheets that these purchases would be likely to inflict, they would need to use their money printing ability to paper them over. Central banks earn seigniorage revenue from all the money they create. This is the difference between the nominal value and the production costs of the money. Because production costs of digital entries are very close to zero, the seigniorage revenue central banks receive from each entry is close to 1-to-1. Still, this would mean that they would need to create new money in the range of tens of trillions of US dollars. By comparison, in 2017, the global nominal GDP of the world was approximately 75 trillion. To distribute such incomprehensible sums of new money, central banks would need to give it directly to consumers and governments. Even in normal circumstances, the production side of the economy would be unlikely to be able to respond to such a massive increase in artificially created demand. And this time there would have been widespread corporate bankruptcies driven by global depression. A hyperinflation would be likely to follow. There's also the alternative that central banks would make a complete U-turn and continue to backstop market losses. This would be the way of Japan, where Bank of Japan already owns over 40% of the sovereign bond universe. It would eventually mean the effective nationalization of capital markets, which would continue to function in name only. We have no historical experience of what the expropriation of modern capital markets would cause. However, it would be unlikely to be anything good, as capital markets have been around for several centuries, and they are extremely important in allocating financial capital efficiency. If central banks take a permanent, active role in the capital markets, it would lead to financial market socialism. It would be likely to bring similar horrors as regular socialism in the form of lost incentives, breaking down of the risk-reward relationship, and inflated asset values. It is unlikely that global central banks will be willing or that they will be allowed to do so. The end game nears. The global balance sheets of central banks turned in August 2018. This marks the start of global QT and thus the end of the most reckless monetary policy experiment in history. And here we are. Figure 1 is the combined balance sheets of the Bank of Japan, European Central Bank and the Federal Reserve during 2018. Source GNS Economics. And so you can see, this is December 2018, this is the turn down. When this is combined with a slowdown in China, the engine of the world's economy since 2008, we have finally entered the endgame of the current business cycle. The desperate measures of central banks in China enacted after the financial crisis have pushed the global debt and financial alchemy to never-seen heights. The global financial system has become rigged with leverage, moral hazard, and regulatory failures to a point where a purge has become all but impossible to avoid. This is the end. And here we have figure 2, gross capital formation in Australia, Canada, China, Euro area, Japan, South Korea, the United Kingdom and the United States in constant 2010 US dollars. Fortunately, even depressions and systemic crises have a tendency to bottom out and recover. This is driven by resiliency. Even when faced by cataclysmic economic shock, businesses and people try to move forward and rebuild their lives. Societies just do not spiral down into anarchy and mayhem, even if the system should break down. Still, every company, household and government should start to make contingency plans. Something biblical is approaching. And this is what I've been saying for quite a while now, and I am favouring scenario 2, the systemic meltdown, where banks just fail to trust each other, fail to lend, overnight lending stops, and the flow of money stops. And of course this is where Bitcoin could suddenly shine, because it is up and running, and clumsy as it may be to transact in Bitcoin, Ethereum and Litecoin, you could see a sudden pressing into service of digital currencies. So this could be a good thing, not so much a bad thing, even though the shock wave will be horrific. So like I say, you want to have some money in the house, some food in the cupboard, and some wood in the shed. Well, as you can see, the scenario that I have thought was going to happen is just a stalling of the economy. And basically the banks just won't lend to each other, and everything creeps to a halt. There's a shortage of cash, and this basically leads to a grinding to a halt of all commerce on the planet, other than that commerce which can be done face to face and with cash in hand, because banks will not be able to transact. They won't want to exchange money with other currencies. It's going to be a complete mess. So I would hang on to a few dollars in your own personal possession should you need them, and especially silver. I mean, no, of course now I'm also saying silver coin is a good thing to have, but you know, loose change is what I mean, because I think that will be an acceptable means of exchange, because it doesn't wear out, you can't tear it, you can't really destroy it, and we will need something to transact with, certainly on a local level. And you know, there are many ways of doing transactions other than with money. Of course, there is the barter system. And you know, when I first came to this area, there was a thing called the farmer's check. Okay, so you'd have a farmer would buy, say, you know, $200 worth of hay from his neighbour, and he would write out a check for $200. Okay, and he'd give it to the farmer, and the next farmer would say buy some lumber off another farm. And so he would sign that check over to that other farmer, and that would carry on, so on and so forth. And so all of this transaction, all of this industry was created with just a piece of paper with a bunch of signatures on it, passing from hand to hand, and yet no real hard money was exchanged, and yet all that business was done. So we just have to think outside of the box. You know, the banks have got us so trained that we think money only comes in one form and one form only, and it comes in many forms. You know, there are our banks, you can trade hours, there are local exchange and trading systems, there are many systems other than hard cash. So please take note of what was said in that story and prepare yourself accordingly. Okay, if you enjoyed this video, please like and subscribe below. Click that big red button. It really does help when you do. And in the meantime, this is Hound Dog Steve signing off. Weekend coming up, so I'm sure there'll be more videos to follow. So you take care, you have a great evening, and we will talk very, very soon. See you now. Bye.